Hello and welcome to the monthly views. Let's quickly get started. Like we started from last month, what we'll do is we'll take a few questions from subscribers and investors, and then we will take a look at some of the other interesting things that have I've come across in the last month. So the first question is when stocks deliver poor earning results for a quarter or two but give good commentary of future performance, how do you decide whether or how long to hold on to them or sell them? Very good question. And similarly, on the same lines, please also discuss one example where you sold because earnings uh, plus the commentary was poor. So first of all, there's no hard and fast rule about how to go about this. You can formulate your own sort of rules more from a risk management perspective. Something that I follow sometimes is I would have a time stop, in the sense that I will wait and see for maybe 2 quarters or 3 quarters, uh, if the result is improving or if there is some major changes that is happening on the positive side. But again, all of that is a little bit subjective, because it will depend on other factors as well. So for example, if a particular company is in an industry where the opportunity size is very very large, and they're just scratching the surface of it at the point, and if the management is good, and the problems that are there look temporary in nature, then you would want to give it a little bit more leeway than compared to a company where you know maybe where the opportunity size is not that large. So again, you have to make that subjective assessment in terms of what you would want to do. If you have a feeling that the problems that the company is currently facing may stretch beyond a year, beyond 2 3 quarters, it might be actually a good idea to reduce your positions or get out completely. The reason I say that is because there is an opportunity cost, and unless you are very very convinced about long term prospects, right, it's sometimes better to get out and then wait for a better time to re-enter. Now what also happens is, you at times when you are holding on to a stock, you tend to fall in love, or some or a psychological bias known as endowment bias. You tend to fall in love with your stock, and then it becomes very difficult to sell. So in a nutshell, if you think that the business is great, it has very very good long term prospects, and the near term is not all that scary, right, then you might want to hold on. uh, Else you can just maybe reduce your allocations or reduce your positions, or sell out completely. So again, it's a very very subjective kind of judgment that you need to take. In terms of examples or cases that we've seen, so for example, last year, we moved out of Lotus Labs because, one, the numbers were not coming. Although the narrative was very strong, everywhere, even the management was talking of big delivering big numbers, but the numbers were not coming. And that is something where, personally, what I have seen is, most of the times management will not tell you that things are going to be bad in the future. It's not because that management is trying to hide something from you. In most cases, what I have seen is, uh, they themselves don't know, right? They are also optimistic about the future. They think that things will get better. uh, but you, as an investor or as an external person, you need to always have a slightly skeptical approach, especially when it comes to what management is trying to tell you. Okay. uh, so that was a particular case of Loras, and today we are in a sort of similar situation with Divis, where Divis has not done well in the last 1 or 2 quarters. Next 1 quarter also looks to be slightly dicey, but in my opinion, the quality of management, the opportunity size is significantly better for Divi. So you're still holding on to it, and unless something major changes, we'll probably continue to hold on and see how it plays out. So that's one example. uh, Other stocks where, for example, PI industries, and this is something that I've done multiple times in the past, especially with PI, is, and this is where I would really give a lot of credit to the management of PI, is in their con calls they're very usually very transparent about what they see. And I've seen that more often than not they are right about how they're assessing their business. So over the years, over the last 10 years that probably I've been holding PI on and off, uh, I've been able to sort of, you know, uh, vary my positions based on the next 1.5 year kind of view. So if the next 1 2 year looks very good, have an added allocation. If the future looks slightly murky, you reduce your allocation. So that's the way I've been playing it. Similarly, IPCA, I think, Aarti, both management did talk about the headwinds that they were facing, although they were temporary headwinds. But these are things that you take into account. Another point I want to make is buying or selling decisions are never taken in isolation, right? Whenever you're taking a buying, saying, selling decision, most of the time, I'm not say never, but most of the time you are weighing it against other opportunities that are available. So if you're buying up one particular stock, you are weighing it against other opportunities that you could buy into at that point in time. Similarly, when you are selling a stock, you are looking at taking that money and deploying it somewhere else. So the relative opportunity should be better in the one that you are buying into versus the one you hold on to. So that's the crux of it. So I don't know whether I was able to answer your question, but there is no formula as such that we can use uh, for this particular problem. You just have to sort of understand how things are, and then take a call based on that. The next question is, what's your view on valuations? I've seen that you do not emphasize much on valuations when discussing a stock. Why is that? That's a very very good question. So when I started, like 20 22 years back, I obviously read a lot of text, a lot of books, and everyone talks of valuations, value investing, things like that, and it obviously appealed to me. Uh, but over the years, when I look at what has worked and what has not worked, and where which stocks have made the most money for myself, uh, or when I look at others, what I found is that valuation matters mostly when markets are at extremes, right? When you have these peaks or bubbles, that is when valuation on the higher side matters. Or at the end of a bear market, when valuations are very very cheap and nobody wants to buy anything, that is another time when valuation really matters. Other than that, in between these two in extremes, I have seen that over focusing on valuations does not really give you the best of returns, right? That's one part. The second thing that I've seen is purely in terms of valuations, and if I use P as a heuristic of valuation, uh, you can use any other ratio or metric. But what I've seen is, as long as growth is sustained, over that 20 25% year on year mark, there is very little contraction in that valuation. And sometimes you have stocks which are uh, at very high P's with lower growth. But for those, the typical cases would be FMCG, right? The companies which are growing at 10 15%, but at 8 60 70 80 90 P, they would be typically FMCG companies where the ROCs would be very very high, and the visibility or the longevity of the growth of that 10 15% growth would be very long, right? So other than those kinds of situations, what I've seen is that if growth is sustained at a reasonably high level, even if the PE is obscene, even if the PE is very very high, it does not usually contract, right? The way it really plays out is, if the growth contracts meaningfully, you will see a very very sharp reduction uh, in your multiples, p multiples. So these are things which are observations that I've done based on what I see around me, and not typically stuff that we read. So most of the time when you read books, especially investment books, what I've seen is that our investment books are what we read is essentially books that have been written by folks who've been investors in that 70s, 80s, 90s in the US, right? And or maybe even 2000. So basically we are looking at US markets, US economic conditions, US business conditions of 40, 50 years back, and we are trying to take the lessons from that period, and we are trying to use it in the context of the Indian economy, and in the here and now. So what I have realized is, instead of trying to do that, if you keep your ears and eyes open and reflect on what is doing well in the market, uh, you will realize that, uh, and base your strategies on what is working, what is not working in our context, in our times. I think it works out better. So I'll give you an example of why I started, and this is one example of why I started moving away from looking at valuations very very closely. So first example, obviously, of a reason of moving away from valuations is the most common or the easiest way of doing valuations was DCF. And when I did DCF, what I realized was that one is, there are too many assumptions. There's a lot of narrative building, storytelling, and a lot changes with a very very small input change in the input parameters. So if you take a very minute difference in the say the interest rate or growth rates, or so small change can make a huge difference in the valuation. So much so that in practical life it becomes completely useless. What use is it practically for me if I do a valuation and it gives me a range of say between 100 rupees and 500 rupees? It's basically meaningless for me, right? And if you are really honest about it, sometimes the variation is actually that significant, uh, because if you have to consider a lot of options, of how the story is going to play out. And again, if you go back in history and look at valuations done by DCF over the years by some of the stalwarts, and these reports are easy to get on the net, right? You go back and get reports for 20 years back or 15 years back, or blog articles of people who are DCF gurus, and you will find that most of the valuations have actually not been practical, right? I mean, you would have lost out on huge opportunities if you followed their valuation models. And that was the first thing. Then this was a practical example. So I was holding Astral. It was Astral Polytechnic at that point in time, and it started trading and at very very high valuations. So I started selling when it went to 100, because mind you, at that point in time the market itself was maybe at Nifty probably was, I don't remember exactly, but maybe around that 18-20 kind of mark. People used to have these kinds of thumb rules that Nifty, if it goes above 25 you should sell, etc. And here was this stock which was at 100p, right? 4x of Nifty. And I started selling and I sold out of my position. And then over the years what I realized is, and here if you look at the slide here, you will see that this was, I think, 2014-15 odd period. The stock went from 100 to 160p, and then it obviously fell down, but it never really, collapsed. In the sense that, okay, if you say that it went from 160 to a 40 or a 50p, and that's a significant contraction, yes, it is. But the fact is, when it had gone to a 40-50p, it was still trading at double or triple of what the market was trading at. So that's number one. Second is that if you look at the stock price, it never really corrected significantly. right? It went sideways, then it went up, it went sideways and it went up. So in a nutshell, this is a stock which is always traded at a high P. And not only this, if you go back and look at, do this kind of basic, number checking, you will find that this is true for, a lot of stocks, Eicher Motors, or any stock which has sustained period of outperformance. You look at a Bajaj Finance, you will see something similar. A price, if you just plot a price to book of Bajaj Finance, you will see the same kind of thing, right? A lot of people would not have bought Bajaj Finance maybe in 2013-14 period, because the price to book had started going up significantly by then, and maybe if I remember correctly, it was twice that of HDFC Bank, which was the gold standard at that point in time. So the point I'm trying to make is that the reality, or the practical, what we see in the market is, as long as, and here if you see the the growth, and the sales growth and the profit growth, profit growth for the last 10 years has been 30%, nearly 30%. For the last 5 years, 27%. Last 3 years has been 35%. So you see that there is a sustained profit growth over the years, which has kept the PE at a high level. Now, uh, just to continue on the same point, this is another example of Symphony. Again, a stock that I owned, again a stock that I sold when it went beyond my threshold of valuations. But if you see, what has happened is, it has, again, I mean, it's maintained that high PE even though earnings have not come through, right? But it has maintained that high PE. Earnings have sort of fallen off, and it has consolidated. So again, the market gives maybe a lot of leeway to a company which it perceives to be good, right? So, can I explain why this happens? I cannot, right? But what I'm just trying to show you is, if you just go through these kinds of examples, and go through hundreds of such examples, you will find that valuations do not drive stock prices, right? And so, looking at the practical nature, I'm personally a pretty hopefully a pretty practical person. What I've realized is, you know valuations is something that you should be cognizant of. You don't go out and buy just because something is cheap, or you don't go and sell just because something is expensive. But yes, you need to have some sense of valuation, that okay, how much am I paying for it, vis-a-vis what am I getting, right? So that basic sense needs to be there. But beyond that, if you do a lot of valuation, analysis, etc., it doesn't really help you. What you should be focusing on, if you are a reasonably long-term investor, is the quality of the business and the quality of the management. Because if those two click, then magic happens. Moving on to the next section is basically, what I've been observing over the last few weeks or months. So this is very interesting. We base most of our fundamental investing on audited numbers from companies, and these are examples. I mean, both these snapshots are from Financial Times. But you know if you look at a KPMG or a Deloitte, and I'm not trying to take these as examples, but my sense would be these are probably more rampant. Some don't get reported, but a lot of these things keep happening. Now the problem is that our entire basis for investing is the audited reports, financial reports of companies. Now, when you see that, how those audited reports or numbers are come up with, then it shakes the foundation of what you're doing, right? So what we really need to come the summary of all of this is, one, obviously we should not take any audited reports for granted. We have to cross check it with our own analysis, our own understanding of the business, our own maybe scuttlebutt, whatever you may call that. That is what we need to augment it with. Because Like in every other sphere of life, auditors are not immune to corruption. So that's something that we very clearly need to understand. On similar lines, again, we have to look at incentives of people who are giving us information or giving us something. These are just two examples, right? You'll have IPOs and everybody coming, all brokerages, all sell side reports, or most of them coming with bullish prospects. This IPO, great, please apply, etc., etc. And most of the time, we get, you know, who reads a DRHP? Right? It's such a fat document, difficult to read, understand. We just go and buy, a Zomato or a Paytm or a Nika or whatever is, because we are familiar with the brand, we've seen it around, we've read newspaper reports. We don't really understand, what are the risks, how's the company making money, etc. And uh, similarly, I mean, if you look at a Zomato here, this particular brokerage, global brokerage, where they have two arms. They have the institutional broking, then have the investment, the investment banking arm. There's supposed to be a Chinese wall between them. I'm hoping that it's there, but it optically looks very bad when you have uh, two arms of the same organization giving two completely divergent views, right? Especially when that particular company or that particular uh, house has a vested interest in it. So if you are the investment bank, you have an interest in it, in terms of uh, seeing that things are that particular stock does well after listing, etc., etc. So again, the point I'm trying to make is none of this is illegal. None of this is immoral, in probably uh, shades of gray. But as an investor, we need to be careful, because at the end of the day, it is our money, right? We are putting our hard earned money, so we have to be careful, and we have to understand what and why the other guys, why somebody is coming and saying that this company you should buy. What is their motive, what is their track record, etc. So something very important to remember. Uh, this is again something I personally think is very important, very interesting. Did not, or has not, received a lot of press. But what is slowly happening, if you see, in India, is that our financial information is slowly getting much more structured. So moving from a cash or a largely cash-based economy to more usage of UPI, more usage of you know banking transactions. What that has led to is, if you look at these smaller MSME players, or even small businesses, uh, if you're going, today, most of the time what I've seen is, even a vegetable vendor today has a phone pay or a Google Pay QR code being displayed. And when you use that and you transact and you pay him uh, through UPI, what happens is you are building that flow of information for that individual, so that just, you have to excuse me. I think there is some hawker going behind. There might be a lot of noise. I don't know. Uh, this is interesting. I mean, it still happens. So coming back to this MSME, so probably this guy who's going on the road outside, he's selling probably some stuff worth 40, 50, 100 rupees, and he has a QR code. Now, previously, if he wanted a loan from a bank, nobody would give him a loan. No bank would give him a loan, because he probably did not have requisite assets to show to the bank. Now the bank can see that, okay, this guy does say, maybe 5,000 rupees of transactions every day, cash flow in. So a lot of lending can move from asset based lending to cash flow based lending. In the formal sector, if you are a salaried employee, let's say when you are getting a home loan, you are getting that home loan more because of of your cash flow. The bank will look at your salary statement, etc., your earnings, and then give you a loan. That is missing for the MSMEs. With cash flow based lending, with GST information now being made available to account aggregator framework, what will happen is a lot of these financial institutions will now get a much better handle of the earnings of these people, these MSMEs, and hopefully that will increase a lot more of credit offtake. So again, these are structural changes. It will take a while to play out, but again, something which is, I think, very interesting and important from a long-term growth perspective of India and the banking and the NBFC space here. With that, we'll come to a close for today. Thank you all for tuning in, and we'll meet again next month.